Let us see the important economic terms or key financial terms related to budget, as it is very essential to understand the budget. So let us begin. Union budget. Now coming to annual financial statement. The union budget is also known as the annual financial statement AFS for a particular fiscal year. It is presented by the government to highlight its expenditure and receipts during the financial year. Under Article 112 of Constitution, an AFS annual financial statement has to be laid before the Parliament in respect of every financial year, which runs from April 1 to March 31st. The budget or annual financial statement also outlines the estimates of government accounts for the next fiscal year, known as budget estimates. It may be noted that budget for upcoming fiscal year has to be sanctioned by the Parliament. Without its approval, the government cannot draw from the Consolidated Fund of India. Now coming to Economic Survey. Economic Survey is a flagship document of the Finance Minister. It is presented every year ahead of the Union budget. The Economic Survey provides detailed information about the Indian economy over the past financial year. Along with the current state of economy, the Economic Survey provides the economic outlook. A team led by the Chief Economic Advisor prepares the document. The document is presented in both the houses of Parliament a day before the Union budget is presented. The first economic survey was presented in the year 1950-51 and till 1964 it is used to be presented along with the Union budget. For common people, the economic survey is a useful document to understand the state of economic affairs in India and the impact of decision made by the Union government. Coming to inflation. Inflation is usually expressed in percentages. It is a quantitative measure of the rate at which products and services in an economy are increased over a certain period of time. When the price of certain basket of commodities increases due to internal or external economic factor, it can be termed as a rise in inflation. A rise in inflation indicates a decrease in country's currency value and purchasing power. While the term has more to do with central bank's policy, it won't be surprising if the finance minister mentions the term during the budget speech. Then comes fiscal policy. Fiscal policy basically outlines the estimated taxation and government spending and serves as a key instrument to monitor the country's economic position. The fiscal policy denotes adjustment in the spending level and tax rates and also refers to the use of government spending and tax policies to influence the economic conditions, especially aggregate demand for goods and services, employment, inflation, and economic growth. It goes hand in hand with the monetary policy, through which the Reserve Bank of India influences the nation's money supply. In case of an ongoing recession, the government may employ an expansionary fiscal policy by lowering the taxes to increase the aggregate demand. Now coming to fiscal deficit. Fiscal deficit means when a government's total expenditure exceeds the total revenue, excluding any external borrowings. However, the fiscal deficit should not be read same as that of debt, which can be an accumulation of many yearly deficits. It is extremely pivotal for developing countries like India to maintain a healthy fiscal deficit ratio, as the total revenue generated is not enough for the government to meet all its revenue and capital expenditure. Since the government requires a large sum of money to fund infrastructural development, developing countries often run on a fiscal deficit towards asset creation. This is why some economists argue that fiscal deficit is not really a bad indicator, but a stance that indicates development. An ideal fiscal deficit should not exceed 4% of the gross domestic product (GDP). Now coming to divestment. Divestment is a process involving the sale of existing assets. It is the opposite of investment. The government has been looking to divest many of its assets which have turned sour over the years in the last year budget. The government set target on divestment as it looked to close the fiscal deficit gap. Coming to capital expenditure. Capital expenditure (CapEx) refers to funds used by government in this case to acquire, maintain or upgrade physical assets such as property, new infrastructural projects or buying new equipment. Capital expenditure is classified as long-term expenditure and usually includes expenses incurred by government towards asset building, including developmental and infrastructural projects. When a government spends money on big ticket projects, the expenses incurred are usually categorized as capital expenditure. Such expenses are not recurring in nature. While capital expenditure (CapEx) is a broad economic term used by several companies, it holds importance in a budgetary context. Customs duty. Customs duty is a levy that is charged when certain goods are imported into, exported out of the country. Eventually, these expenses are passed on to the end customer. Since custom duty is outside the purview of Goods and Services Tax (GST), the government has room to announce the changes, if it wants, in its budget presentation. Customs duty is a key component of budget and many sectors will be keenly awaiting an announcement regarding the customs duty. Then coming to GST, Goods and Services Tax. Unlike custom duty, changes to the Goods and Services Tax (GST) are not announced in the budget. The GST Council takes a call on any changes in the GST slab and structure. While Finance Minister may speak about GST in her budget speech, but no changes in this regard will be announced in the budget. Now coming to direct tax, income tax. Direct taxes include income tax and corporate tax. The government is unlikely to make any major announcement related to income tax this year. However, some tweaks can be expected. Then coming to current account deficit. The current account deficit is a measurement of country's trade where the value of imported goods and service exceeds the value of exports. It is a component of country's balance of payment. Revenue deficit. A revenue deficit occurs when the government's net income or revenue generation is less than the projected net income. This is a situation where the actual amount of revenue or expenditure is not in line with budget revenue and expenditure. It is a key indicator to determine whether the government is overspending from its regular income. Revenue surplus. Revenue surplus is the opposite of a revenue deficit. It is a situation where the government's net realized income or revenue generation is more than the projected net income. The actual revenue and expenditure is more than the budget estimates. Then plan and non-plan expenditure. Expenditure usually has two components, plan expenditure and non-plan expenditure. The plan expenditure covers budget estimates that are determined after discussion with all stakeholders or ministries. Non-plan expenditure, on the other hand, mostly involves the revenue expenditure, though it also includes the capital expenditure. These are expenses incurred by government on interest payments, statutory transfers to the state or union territories, pension payments, salaries of government employees. Non-plan expenses constitute a major part of government's budgetary expenses. Debt servicing, defense expenditure, interest payment comprise the biggest expenses under this category.